Ready for a deep dive into market dynamics?
We will be summarizing vital insights from experts like Matt and Jeff.
And you'll get all these crucial takeaways in just minutes.
Stick around as we uncover why inflation trends are so critical right now.
Welcome to Financial Insights in Minutes, where we deliver efficient summaries of the day's most important financial clips.
And up next, Matt analyzes today's CPI inflation data and its market implications.
Anchors away as we dive into today's topic about CPI inflation data and its impact on the market.
Let's get straight to the facts. Today, the talk is all about the latest CPI report and what that means for inflation trends.
We're navigating some stormy financial seas. What insights can we pluck from today's data? What's the core narrative behind this CPI release?
The main takeaway from this CPI report is that inflation appears to be stabilizing, but we need to be wary of underlying pressures that could lead to volatility.
First up, let's dissect the CPI overview. How did the latest figures stack up?
CPI came in hot with a month-over-month inflation rate of 0.2% and year-over-year at 2.4%. This has implications on Fed policy too.
And how do these numbers impact the Fed's playbook?
The implications are significant. If inflation continues to hold steady, we might see the Fed pause on any further rate cuts. It's a tightrope act.
Switching gears to the job market, what's brewing there?
The labor market isn't looking too rosy either. We saw a spike in initial job claims to 258,000, which could dampen consumer spending.
What are traders doing in response to all of this?
Market reactions are teetering on cautious optimism. Traders are bracing for volatility as they digest the impacts of this CPI release.
Now let's take a look into the crystal ball. What are the inflation predictions?
We're predicting a gradual decline in inflation rates over the next quarter, but watch for potential resurgence in housing and services. Those sectors remain unpredictable.
As we wrap this up, what's the big picture takeaway?
The CPI report is a mixed bag. Caution is key as inflation remains a significant variable in the market climate. Investors should strategize accordingly.
But hold on tight, because up next, we have insights on China is bailing out their entire banking system.
And it features exclusive insights from Jeff Snider of Eurodollar University, so don't go anywhere. You won't want to miss it.
Anchors away. Let's navigate the turbulent waters of China's banking system.
Here's the scoop. Recently, the government announced a massive recapitalization plan up to 1 trillion yuan for its top 6 banks.
Whoa, that sounds like a big wave crashing. What does this really mean for China and the global economy? So what's the central thesis here? Why are Chinese banks in such dire straits?
The core message is clear. Despite market jubilation, China's banks are grappling with a credit crisis that their government has desperately acknowledged.
Let's break down those key points. What are the details of this big announcement?
Indeed, the capital injections aim to strengthen major lenders, highlighting the gravity of China's banking challenges.
And how did the market respond to all this?
Well, the initial euphoria was short-lived. Stock prices tanked, revealing the underlying skepticism about the bailout's efficacy.
What about the bank's lending practices? Are they backing off?
Absolutely. They're holding back credit, suggesting deeper issues with hidden losses that could yet complicate the economy.
Looking back, have they navigated these waters before?
Yes, previous bailouts have occurred, but often led nowhere, just a temporary fix rather than a sustainable solution.
And what do the global ripples look like?
Given China's economic heft, any banking complications could send waves across global markets. Definitely a situation to watch.
Time to pull out the crystal ball. What are the predictions?
The outlook on real estate remains grim. Stabilization could remain elusive, leading to nationwide repercussions.
Any predictions that might shock us?
Long-term effects seem inevitable. If these crises deepen, we may see a continued cycle of financial distress.
Wrapping it up, what are the takeaways?
The message is clear. Beijing's attempts to stabilize banks are critical, but they also reveal the depth of the economic challenges.
And how about the stock market's future?
Expect volatility. Short-term gains can mask underlying instability, making market predictions tricky.
But hold on to your hats. Up next, we dive into insights from Game of Trades as we compare October 2024 versus October 2007.
This next segment promises some intriguing parallels. You won't want to miss it.
Time to navigate through these waters. How do the economic scenarios of September 2024 and 2007 compare?
Here's the scoop. The recent interest rate cut by the Fed has market watchers recalling the events of 2007, but are the signs really similar?
Let's dive right in. What do the numbers say? The heart of the matter is, are we heading toward a recession, or are we just bumping along?
The thesis poses vital questions. What similarities exist between now and then, and what unique markers might shape our future?
What about those interest rate cuts?
Historically, both years experienced a similar cut from the Fed, which led to market optimism. But what followed was a different story.
And those leading economic indicators?
They suggest a peak, but they have indicated potential downturns for a while, leading many to worry about what's to come.
What about the job market?
A rise in unemployment rates in both instances isn't the kind of signal investors want to see. It points towards economic slowdown.
Now, what about oil prices?
In 2007, they were surging, contributing to economic strain, whereas in 2024, they show a downward trend, which some perceive as a relief.
Let's dive into the market's internal strength.
Today's breakout has broad participation across stocks. Unlike in 2007, the market indicators look more robust, which is encouraging.
What do the predictions say?
Expect that rising unemployment will be a bellwether for economic shifts, so we must keep a keen eye on future reports.
What should we anticipate for inflation?
Stable oil prices today suggest less inflationary pressure, but it might also indicate sluggish economic growth.
To sum it all up, what should we take away?
We see similarities, but also crucial differences that might just keep the ship steady in these turbulent waters.
What final thoughts should we consider?
We must remain vigilant. The forecasts warn of cycles, and being proactive might make all the difference.
But hold on to your life jackets. Up next, we dive into insights from David Rosenberg.
He's going to connect the dots between baby boomers and the looming bear market.
Anchors away on our next topic. Are boomers really sleepwalking into a bear market?
Here's the scoop. David Rosenberg alerts us to potential risks ahead for the older generation heavily invested in stocks.
That sounds like a financial iceberg ahead. What specifics does David share about their asset allocations? What's the big takeaway from David's insights?
The core thesis is alarming. Rosenberg highlights that an unbalanced investment in equities could spell trouble when the market shifts, hinting at a major consumer recession.
So, what's the economic landscape shaping up to be?
Rosenberg explains the U.S. is hanging in there, but warns about stagnation in Canada and recession whispers from Europe. It's like a game of economic whack-a-mole.
And what about the baby boomers? What's David saying about their investments?
They're heavily invested in equities, 60%, which is worrying. Rosenberg insists they should diversify to avoid a financial shipwreck.
What's the story with interest rates?
Rosenberg suggests that with looming cuts from the Fed, lower interest rates could dictate the future course of investment and consumer behavior.
What can we expect in the way of predictions?
Rosenberg warns, if savings rates rise significantly, consumer spending will drastically shrink, potentially bringing on a recession.
And how about the market's future?
David projects sharp market turns ahead, which could leave boomers scrambling. It's a potential perfect storm.
So what should we take away from this?
Rosenberg emphasizes the urgent need for diversification in asset management. Boomers must prepare for potential squalls on the financial horizon.
And what's the final takeaway for viewers?
Being informed and prepared can mean the difference between thriving and merely surviving. Financial literacy is key.
But hold on to your seats. Up next, insights from Darius on market crises, so stick around.
This is going to be a wild ride, folks. Trust me, you won't want to miss what's coming next.
Anchors away. Let's dive deep into the concept of the fourth turning and its impacts on the markets.
Here's the scoop. Darius, founder of 42 Macro, analyzes how this generational crisis shapes market dynamics.
Sounds riveting. What should investors be wary of in these turbulent waters? What sends ripples through investors' minds?
Darius argues that while geopolitical concerns loom, the underlying fundamentals show a resilient economy. It's all about positioning.
What's the current temperature of the market?
Goldman Sachs predicts an S&P 500 of 6,300 by early 2025, but watch out for political headwinds.
What's the liquidity landscape looking like?
It's trending higher, Darius emphasizes that if you don't track liquidity, you're sailing blind in this ocean.
And how do geopolitical issues factor into this?
Darius believes that while tensions exist, asset markets remain resilient as long as liquidity holds up.
What's brewing with the upcoming elections?
Darius warns that the candidates' policies could disrupt current economic strategies, sparking market reactions.
Let's connect the dots of the fourth turning.
Historically, it reshapes economic structures. Expect shifts toward populist policies.
What's Darius forecasting for future economic policies?
He expects rising populism, which may affect market operations significantly.
What sectors should investors keep an eye on?
Darius remains bullish on stocks and risk assets, citing strong liquidity as a driver.
Wrapping up, what's the big takeaway?
Darius advises a proactive approach to investing during these turbulent times.
But wait, there's more. Up next, we'll dissect the October numbers with insights from Tom.
You won't want to miss it. There's a lot to unveil.
Anchors away as we dive into October's surprise market moves.
Let's get straight to the facts. October's showing unexpected bullish signs, particularly with the recent breakout.
What does that mean for traders and investors? That's the scoop we're unraveling right now. What's at the core of this surprising trend?
The thesis suggests that market sentiment may be changing, with historical data indicating a 75% chance for October to close positively after reaching new all-time highs.
Let's break it down. What does it mean that the S&P just broke through key resistance?
It indicates strong market momentum, often leading to a gamma squeeze, where options expiry can propel prices higher.
What's the historical take on October performance?
Interestingly, data shows that when October starts positively, there's a high chance, around 75%, that it will end positively, especially leading into a traditionally strong fourth quarter.
And what about volatility? Is the market feeling nervous?
Absolutely. Investors are hedging risks with put options, indicating nerves, especially with forecasts anticipating potential downturns.
Looking ahead, what predictions does Tom have for the coming months?
He expects bullish momentum could persist, especially if earnings reports exceed expectations, potentially triggering even more market confidence.
Any whispers about the cryptocurrency market?
Yes, it's poised for volatility, especially with Bitcoin at a critical inflection point. Traders should be on high alert for dramatic movements ahead.
As we wrap up this analysis, what are the major takeaways?
Tom emphasizes that traders should stay alert and make strategic decisions based on market indicators, as the opportunity for gains is significant.
If you're enjoying these insightful tidbits, now's the time to hit that subscribe button.
Your support helps us continue creating valuable content to help you master the markets.
Today, we've gathered insights from our esteemed guests on some pivotal financial topics.
Absolutely. Matt shed light on CPI inflation, highlighting the increasing economic volatility.
And Jeff Snider pointed out that the recent bank bailouts in China hint at global instability.
Darius Dale's warnings about potential downturns echo predictions from 2007, which should raise eyebrows.
While David Rosenberg here believes inflation might stabilize, he warns against the foolishness of underestimating recession risks.
So as you can see, there's much to consider moving forward in this shifting economic landscape.
If you found value in today's discussions, don't forget to like and subscribe to our channel to keep up with future insights.
Indeed, your support motivates us to deliver more essential financial content.
Until next time, keep investing smartly and check out our other videos for even more insights.